Hello, I'm Sophia, and this is The World Unpacked. This week on the show, we're talking about the failures of our modern global trading system and how to fix them. Now, I think it's probably fair to say that we seem to have moved beyond the free trade consensus of the globalization era. Few politicians today would still publicly support the assumption that trade unrestricted by national borders makes everyone more prosperous. And under President Trump, the U.S. has wielded tariffs and an industrial policy to reshape the international trade order to better serve American interests. The Biden administration has upheld and doubled down on many of these. But these interventions do not yet add up to a new trade policy consensus. That's what Michael Pettis, my colleague, argues, who we have on the show today. We will be diving into a fairly provocative new argument that we need more trade interventions to create freer trade. Michael Pettis argues that by targeting specific trade violations rather than balanced flows, global trade policy has been focusing on the wrong outcome, and that new trade rules are needed to create a better international trading system that preserves the freedom of nations to direct their economies while harnessing the benefits of trade. My guest today is my colleague, Carnegie nonresident senior fellow Michael Pettis, who together with Erica Hogan is the author of the recent Carnegie paper, Trade Intervention for Freer Trade, and expert on China's economy. Michael, welcome to the show.
Thanks very much.
So, Michael, I want to start with an overview of the problem as you see it. You argue that the global trading system as it stands today is fundamentally broken. You're not alone in that, but what are your reasons?
Well, the first thing that I would say is that we're not arguing that free trade is a bad system. On the contrary, free trade does have problems, but free trade under comparative advantage maximizes production. That's very clear. The criticism in our publication is not that we have a problem with free trade, but that we don't have free trade. We have a highly distorted trading system. And it's the kind of trading system that people like John Maynard Keynes or Joan Robinson warned about a long time ago in the 1930s and 1940s. And what we need to do is to move towards a better trading system. But because we are not going to move towards a better trading system unless the deficit countries, primarily the U.S., take steps to accomplish that, then it's not going to happen. So countries like the U.S. must intervene in trade in ways that return us to a better trading environment.
So when you're saying the system as it currently stands is not free, you are talking about those surpluses.
Yes, because in a free trading environment where countries specialize in comparative advantage, the purpose of exporting is to pay for imports. And you want to maximize your imports because you want to maximize the welfare of your country. So you specialize in those areas of exports where you have comparative advantage in order to maximize your imports. But we don't live in that world. We live in a world in which the purpose of exports is to basically externalize the domestic imbalances that you generated in creating those exports. To use Joan Robinson's phrase, it's a way of exporting unemployment.
I've heard you use examples before to describe this, and I think it would be really, really useful just in setting up the problem for our listeners. If you could walk us through an example of what this looks like in practice.
The very classic example, the easiest example to explain is probably Europe in the first decade, right? So in the late 1990s and early 2000s, Germany had a number of problems. It had high unemployment. It had low savings. It was running a trade deficit, probably problems related with the reunification of East Germany. Now, there were things that Germany could have done to resolve those problems domestically. But what they ended up doing in 2003, 2004 was implementing a series of labor reforms. And labor reforms is a euphemism for repressing wage growth. What happened after those reforms were implemented was that German workers received a lower and lower share of what they produced, and the flip side of that was a surge in business profits. Now, is this a good thing or a bad thing? If the surge in business profits had been used to invest in Germany's economy, this would have been a good thing. Germany would have been richer, the world would have been richer. But it wasn't. Investment actually came down as a share of GDP. So what Germany did was, in order to continue with this high level of production, They exported the excess savings to countries like Spain and Italy and Portugal, et cetera, and they ran large trade surpluses with those countries forced to run the corresponding deficits. So they implemented policies that reduced domestic demand, and instead of paying the cost of that reduction in domestic demand, they used trade to externalize the cost onto their trade partners. And that's a world we don't want to see.
Right. So you are a China expert, really, and we can't really have this conversation in the US without talking about China. China plays a pivotal role in the world's trade imbalance. It accounts for under 20% of global GDP, but produces nearly 30% of global manufacturing output. How did this happen? So what kinds of policies has China put in place to encourage and sustain such a large trade surplus? And then in particular, I'm curious if you could explain how industrial policy plays into the way a country like China sustains trade surpluses. You argue in your paper that trade policy and industrial policy are not really separate. They're interconnected. Changes in one will always affect the other. So why is this important when we think about how to fix the system?
Because China implemented industrial policies in the 1990s that made a lot of sense. China at the time was hugely underinvested, so it needed to raise investment as quickly as possible. And investment has to be financed with savings, either domestic savings or foreign savings. Foreign savings are very risky, so they focused on raising domestic savings. And the way you raise domestic savings, it has nothing to do with culture. The way you raise domestic savings is reduce consumption. That's saying the same thing. And you reduce consumption by giving consumers, households, a lower and lower share of what they produce. And so they consume a lower and lower share of what they produce. And by definition, they save a higher share. Now, this was very good for China because its very high savings rates, highest ever recorded in the world, were channeled through the banking system into much needed investment. The problem is that with such a high growth rate in investment, China reached the point where it was no longer able to absorb additional investment productively. So it had to bring investment down. But if you bring investment down, then you run into a big problem, because if you bring investment down without raising consumption, total demand goes down. And in a closed economy, if demand goes down, production has to go down, which means you have to close factories and fire workers. Instead, what China did was exported its excess production to the rest of the world. So it followed a very good industrial policy, but once that industrial policy reached the end of its shelf life, it was unable to change, it was unable to adjust, and the result was this explosive growth in the trade surplus.
So countries like China with large trade surpluses have a big advantage in the current system, is what you argue. But what does this matter for the average American, for consumers? How do these trade imbalances actually impact the lives of families in Middle America, consumers in Washington, D.C.? They are often the target of political slogans and campaigns around this issue. So how are they actually affected? How does the Chinese trade surplus affect other major economies outside the U.S.?
Well, first of all, I wouldn't say that China's trade surplus gives it an advantage. China's trade surplus is a way of dealing with a huge disadvantage. It's very weak domestic demand. In fact, generally, surpluses are not good things. They just mean domestic demand is very weak. So how does this affect Americans? Well, let's pretend there's only one other country in the world, the U.S., so that we can simplify it. In order to avoid having to reduce domestic production, it must sell its excess production to the U.S. Because the U.S. has completely open trade markets and, more importantly, completely open capital markets, China's excess savings go to the U.S., and they force an adjustment in the U.S. economy. Now, this gets a little bit technical, but when you import capital, you run a current account deficit by definition, and there is a gap between your domestic investment and your domestic savings, right? So when Chinese money moves to the U.S., then American investment must be higher than American savings. That's a requirement of the balance of payments. So if American investment goes up, that's a good thing. And this is what happened in the 19th century when the U.S. was underinvested relative to its ability to absorb it, but it didn't have enough savings to fund it. So we imported savings from abroad. But that's no longer the case in the US or in any advanced economy. Savings is not a problem. There's too much savings. The problem is demand. And American companies sit on huge piles of cash, which they're not investing. So when investment comes into the U.S., when foreign savings come into the U.S., if investment doesn't go up, savings must go down.
I want to talk about tariffs as a response to all of this. I mean, U.S. economic competition with China has become a sort of rallying cry, I think, for both political camps in the U.S. and the prism through which administrations tend to see trade, security, technology policy. And we have seen tariffs under former President Trump and then also under the Biden administration. And several economists argue that tariffs can lead to higher costs for consumers and don't actually sufficiently target the countries that are responsible for the trade distortions. In your view, how successful have the Trump and the Biden administration's tariffs been in reducing the trade deficit and in improving the U.S. economy, I guess?
Tariffs are easy to understand, and bilateral tariffs in particular seem very easy to understand, but we misinterpret them. Bilateral tariffs may have security implications and other implications that I don't want to get into, but they have absolutely no impact on the trade imbalances. Because remember, the problem is twofold. China saves far more than it invests, and it invests those excess savings in the United States. If the U.S. puts tariffs on Chinese goods, it doesn't change the excess of Chinese savings over Chinese investment, and it doesn't change the flow of Chinese investment into the United States. So the Chinese surplus will be as big as ever, even if the surplus with the United States contracts, and the American deficit will be as big as ever, even if the American deficit with China contracts. That's the problem with bilateral tariffs. You can fix that problem by implementing global tariffs. It's the only way to do tariffs. You have to do tariffs on everybody or nobody. Otherwise, it's a waste of time. The problem with tariffs is that they're politically very contentious. There is a belief that they're inflationary. That's not true. That depends on how the tariffs are implemented, but there is that political belief. And more importantly, they penalize all your trading partners, not the ones that are running surpluses, but anyone who exports to you.
Before we break, can you just briefly explain what you mean when you say tariffs on everybody or no one at all?
Okay. The U.S. plays a very special role in the global economy. It's basically, we always think of the U.S. as the consumer of last resort, which it is. But it's the consumer of last resort because it's the absorber of last resort of excess savings in the rest of the world. If you have excess savings, you do what you want with them, and then whatever is left, you dump in the U.S. because that's the safest place to put savings. It has the best legal system, the deepest financial markets, et cetera, et cetera. So the problem is the excess savings of the rest of the world and the role of the U.S. in absorbing those excess savings. If you want the U.S. to stop running deficits, which means if you want the U.S. to stop absorbing excess savings, then you have to do something that either reduces excess savings in the rest of the world or that prevents foreigners from dumping their excess savings in the U.S. Bilateral tariffs don't do this because they don't change the global relationship of savings and investment. They just shift them around. If the U.S. were to impose tariffs across the board on every country, that's the equivalent of depreciating the dollar, which is the equivalent of appreciating foreign currencies. And when a currency goes up, that basically transfers income. This gets a little technical, but that transfers income from businesses to households. And so it increases the household share of GDP, and so it reduces savings. So global tariffs can act to reduce the excess savings of the rest of the world. They have to be quite high to do that, but that's how they work. Bilateral tariffs don't change excess savings at all.
So we've talked about the problem. Next, we're going to talk about some solutions that Michael has put forward. That's coming up next after this short break.
Hi, I'm Annalise Riles, professor of law at Northwestern University, anthropologist, and host of Everyday Ambassador, a new podcast that peels back the curtains of high-stakes diplomacy and gives everyone backstage access to the most powerful methods of leadership. On each episode, we'll break things down into deceptively simple moves that everyone can make to help build a more peaceful and sustainable world. So join me and become an everyday ambassador on Apple, Spotify, or wherever you like to listen.
Thanks for listening to The World Unpacked from the Carnegie Endowment for International Peace. If you enjoy the show, make sure to check out other audio series and podcasts from Carnegie. Subscribe to Carnegie podcasts on popular podcast platforms such as iTunes, Stitcher, or wherever you listen to podcasts. Now back to the show. We're back. So, Michael, I want to talk about what it would take to restructure global trade policy and create a system that is fairer and more mutually beneficial to, I guess, all parties involved. And you argue that restrictions are the key to making trade freer, to changing the current system. What do you mean by that, and what kinds of new policies would the world need to adopt?
Well, one thing to remember is that because the U.S. absorbs 40 to 50% of all global excess savings and all trade deficits, and because the U.S., Canada, Australia, and England together absorb maybe 70 or even more, those are the countries that you need to get involved. Because if the deficit countries take steps to eliminate their deficits, by definition, the surpluses also get eliminated. So what's really key is getting those countries involved, plus maybe Mexico or one or two others that run systematic deficits.
So when you say we need to get these countries involved, what's the next step? What are the policies concretely that they would have to agree on?
Okay, there's a hierarchy of solutions, in my opinion. The best solution is to create, let's call it a new Bretton Woods, in which we come to a new trade agreement. And it doesn't have to be that new. We can go back to the old Bretton Woods and take the rejected proposal, Keynes's proposal, in which very specifically there were measures against systematic surpluses.
Which was rejected at the time. Why?
It was rejected at the time because the U.S. was the biggest surplus country, and the U.S. wasn't going to do anything that penalized surplus countries. It was a big missed opportunity, but when you're the most powerful, you get to make mistakes.
And if we try to do the same thing today, presumably the big surplus countries again might have something to say about that.
Absolutely.
Yes.
But there is a big difference. The climate is very, very different in the sense that back then the world was still saving short after World War II and even after World War I, which hadn't been fully rebuilt. The world desperately needed capital. And so exporting capital was a good thing. Europe was rebuilt on American capital. Japan was rebuilt on American capital. Today, exporting capital is not a good thing because capital doesn't go to where it's needed, which is the developing countries. Most of it goes to the rich countries that don't really need it. So the balance of power has shifted a lot. And it shifted in the direction of the absorbing countries, right? So that's why it's very important to get the U.S. and a few other large deficit countries together. And if they agree, then everybody else has to agree. So the hierarchy is, first of all, a new trade agreement where members of the trade agreement agree that they can no longer run large permanent imbalances. They have to take steps. If they have weak domestic demand, they have to boost domestic demand. They can't export it to their trading partners. That may be politically difficult to pull off, not as difficult as people think, because it doesn't matter whether China and Germany and Japan and South Korea agree. All you need is an agreement among the leading deficit countries. But given the conflict in the world and the sort of less friendly feelings, that may be hard to pull off. If that can't happen, then the U.S. can act unilaterally. And the most efficient way for the U.S. to act unilaterally is to address the root of the problem. The problem is the deficit, but the deficit isn't caused by Americans importing more than they export. The fact that Americans import more than they export is the consequence of the problem. And the problem is that excess savings in the rest of the world are mostly dumped in the U.S. because that's the safest place in which to dump them. Now, if the U.S. absorbs foreign capital, foreign excess savings, it must adjust in the form of either higher investment or lower savings, right? By definition, foreign inflows cause a gap between investment and savings. If the U.S. were a rapidly developing economy, like it was in the 19th century, those inflows would probably fund higher investment. But that's no longer the case. The U.S. doesn't need foreign savings. American companies sit on huge piles of savings, and they don't invest them because they don't believe there are investment opportunities. So when more savings come in, they don't increase American investment. So by definition, they must reduce American savings. So the way America responds to all of this is either in the form of higher unemployment, higher debt, higher household debt, or higher fiscal deficit. If that's the problem, then the solution is not to let foreigners dump excess capital in the U.S. And the way to do that, maybe the most effective way to do that, is to tax capital inflows. Now, a lot of people are worried about that because they think Americans, because we save so little, we need foreign inflows to balance our accounts. It's not true. Foreign inflows force down American savings. Remember, if they don't force up American investment, they must force down American savings. So it's not that the U.S. imports capital because Americans save too little. It's Americans must save too little because they import so much foreign capital. If we don't tax capital inflows, tax imports directly. Taxing imports is a way of rebalancing foreign excess savings. It's not a very easy way. It's politically quite contentious, and it punishes everybody the same, whether they run surpluses or not, but it is a way of doing so.
So, Michael, you presented the solutions as you see them, some more politically feasible, some perhaps less politically feasible, both at a domestic and an international level. This is not the first time that you make this case. And in fact, you've been talking about this for a few years now, and in a sense, the international environment has caught up. Do you feel that now when you're having these conversations in Washington and Brussels, elsewhere, there's more receptivity, more openness? Where do you see the last hurdles, I suppose, to where you would like the global trading system to go?
There's far more receptivity because I think the global environment has changed in ways in which it made the problems very, very clear. To the extent you have an open capital account and an open trade account, if your trade partners intervene with industrial policy, you automatically absorb the obverse of that industrial policy. So if you look at countries like the United States, manufacturing represents 11% of the U.S. economy compared to 16% globally. Some people will tell you that that's because the U.S. is an advanced economy and manufacturing is a low share for advanced economies. And of course, that's totally nonsense. If you go to Germany, Japan, South Korea, other advanced economies, manufacturing is well above the global average. In fact, there's a very simple rule. If you look at advanced economies with trade deficits, their manufacturing share is lower than the global average. And if you look at advanced economies with trade surpluses, their manufacturing share is above the global average. So why should that be? Is that a coincidence? Well, it's too much of a coincidence to be a coincidence. And it turns out because it's the way trade works. If you have an open economy and an open capital account, let's say there are two countries, Germany and Spain, everything is going well, and Spain has an open capital and trade account, and Germany implements policies that force households to subsidize manufacturing, which it did, by the way, in 2003, 2004 with the Hertz reforms. So Germany's industrial policies forced up manufacturing and reduced consumption. And it could have done that, for example, by depreciating the German currency. Well, the world has to balance. So if the German share of manufacturing went up, then the Spanish share must have gone down. And if the German share of global consumption went down, then by definition, the Spanish share must have gone up. Spain forced its manufacturers to subsidize its households. But you might argue Spain did no such thing. Spain implemented no industrial policy at all. That's the point. Because Spain, in my example, has an open capital account and an open trade account, it automatically absorbed the obverse of Germany's industrial policies. And that's the point that I think Europe is increasingly worried about, because if China has very aggressive industrial policies and the US has very aggressive policies, then either Europe has to do something to prevent itself from absorbing the obverse, or it will pay the cost of those industrial policies. And as Joan Robinson explained way back in the 1930s, once some countries engage in trade and industrial policies, in beggar thy neighbor policies, it has to spread, because if you don't do it, you pay the cost. And if you do it, then other countries pay the cost. So everybody has to do it.
So there's no escaping industrial policy?
No, there is no escaping. Unless we do one of the things that I mentioned earlier, a new trade agreement, or policies that protect you from absorbing foreign trade industrial policies.
Michael Pettis, I think this was a fantastic overview. If people want more, they should read your paper. At this point of the show, I like to ask our guests what book or paper they would recommend to our listeners to better understand the issue. I have a suspicion that I know what you're going to recommend, but perhaps you'll surprise me.
Well, I could recommend my own books, but what I tell all of my students is that the best way to understand economics is not to read economic textbooks, particularly on trade, but it's to read economic history. And as you read these histories, you'll see how capital flows affected trade flows and how these things work generally.
Michael Pettis, if you're not going to do it, then I'm going to recommend again the recent Carnegie paper, Trade Intervention for Freer Trade, by Michael Pettis and Erica Hogan. Michael, thank you so much for coming on the show.
Thank you.
You have been listening to The World Unpacked, an audio production of the Carnegie Endowment for International Peace. Views expressed are those of the host and guest panelists and not necessarily those of the Carnegie Endowment for International Peace. Subscribe to Carnegie podcasts on popular podcast platforms such as iTunes, Stitcher, or wherever you listen to podcasts. You can find our episodes on Carnegie's YouTube channel as well. Learn more at thecarnegieendowment.org. Thanks to the excellent Heewon Park, who is our audio engineer and executive producer, and to Cameron Zotter, who is our videographer. I'm Sophia Besch, Senior Fellow in the Euro Program and host of The World Unpacked. Thanks for listening.